Stocks, in a few words, is a portion of a company. Each portion is called a share. But why do stocks even exist? Let's go back to Jack, who was starting his business. When Jack started initially, he owned 100% of the company. However, if he decides to grow, he will need to raise some capital and get some help. He could get a loan, but he can also sell a part of his business to raise some cash. Even big companies like Google need cash to launch projects. However, these projects are much bigger than Jack's business. An equity offering is when a company sells some of its shares to the public in the goal of raising some money. So the investor like you and me buy the share and the company gets to use our cash to grow the business. And as the business grows, our share, which is a tiny fraction of the company, grows with the company. That's how you can make money with stocks. Let's go ahead with an example. Miracle Grass, a lawn mowing company, wants to bring the business to the next level. The owner wants to buy new lawnmowers, but he doesn't want to get a loan. He decides to turn to investors and decides to sell 10% of his company to Michelle, a local investor. Suppose the business today is worth $10,000. Michelle buys 10% of the business for $1,000 and receives her shares, which equal to 10% of the business. Everyone is happy. Michelle owns part of a business she likes, and the owner is now able to buy new lawnmowers. 1 year later, Miracle Grass is now worth $20,000. The company received a lot of contracts and grew in size. Michelle, on the other hand, still owns her 10%. However, this 10% is not worth $1,000 anymore, it's worth $2,000. As the company doubled in value, her investment doubled as well. We can see that there's a link between the business growing and investment growing as well. Buying shares or stock from a company is a bit more complicated, however. The easiest way to buy shares is from a public company. This means the company has allowed the sale of its shares to the public through what is called an initial public offering or an IPO. After an IPO, these shares are sold in a market called the stock market. Examples of stock markets are the NYSE, in your stock exchange, and the NASDAQ, which matches buyers and sellers. For example, suppose you own 1 share of Apple, a public company that you probably already know. You probably bought it through your broker, but your broker bought it through the stock market. When it's time to sell it, your broker will find a buyer on the market that is willing to pay the same price, and boom, the sale is completed. Let's sum up what we learned up to this point. Stocks are a way to invest in a company and gain from the company's expansion. But what is that price that you see when you search for a stock? This price is the price per share, which basically signifies how much the last person paid for a share of the business. A lot of transactions occur each second, but the price that is shown is the latest price that was paid to buy or sell the stock. By multiplying the price per share by the number of shares that exist in the market, also called shares outstanding, you get the value of the business as thought by the market. As this value goes up, your share price goes up, and you make more money. This should give you a good summary of stocks and should create a strong basis for you to be able to trade in the challenge.